I think the remarkable thing at the moment is actually confidence has remained very strong, and whilst confidence remains strong and interest rates have remained low, affordability in general has been in some areas stretched, but it's been basically okay. I think history tells us the things that we really need to worry about are, to a degree, if there was a sudden rise in interest rates, yes, that would be a problem, but I don't see any sign of that anytime soon. Even if we did see a rise, I think the indications are that it would be small and slow and gradual. The real concern for indebtedness comes with the threat of unemployment. And thankfully, again, we've seen employment levels remaining remarkably high and remarkably resilient. But so I think that those are the things to watch as much as the actual interest rates and indebtedness levels.
How do you assess the ability of your customer base to withstand a rise in interest rates?
Well, the way that we do it, which I think now is the way that pretty much all lenders do it, is we look at the customers, the members' affordability, their income and their outgoings, and then we look at what their mortgage payment would be. But then we also say, what if interest rates went up to, say, 5% or 5.5%? Would they still be able to pay those mortgage payments? And if the answer to that is yes, then we make the loan. But there have been a lot of changes in the market over time. There have been changes on the tax treatment, particularly in the buy-to-let sector. That changes things. And we also now have a generation in mortgage terms who've never seen an interest rate increase on their mortgage. So as well as the practical maths of it, there's also a sort of emotional question about do people know and understand that if rates do go up, they're going to see a change in their monthly outgoings.
So customers need their hand being held more than they may have done in the past?
I think so. We saw about a year ago when there was some speculation that interest rates were going to go up. We suddenly received a lot of phone calls from people saying, well, what exactly does that mean? And those phone calls took longer than we expected because we were explaining to people what's involved and how it would work if indeed it happened.
And whilst we all talk a lot about the strength of households themselves and their financial resilience, what about the banks and the other lenders themselves? I mean, clearly the stress tests are far more robust than they were, say, 10 years ago. Are you confident that you could withstand, for example, a serious downturn in the housing market?
Well, yes, we are. You've seen that the results for all the stress tests are available, and the bank understandably tests that scenario pretty thoroughly. And we are very well capitalised, but the whole industry is in a very, very different position than it was, 10 years ago. And I think that a lot of the lessons have been learnt. Of course, one thing we can be sure of is whatever happens next will be different to the past. So I'm not saying that everyone is prepared for every eventuality. But I do think that the regulator, the Bank of England, and the financial services sector itself is really pretty unrecognisable from the one that was going into the events that started to unfold now 10 years ago.